Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. It's been about 3 years since I've had this guest on. I've had an embarrassment of bookings, but he's a good one. He is Nick Barisheff, the CEO of Bullion Management Group up in Canada. Here is his book that he came out 3 years ago, $10,000 Gold, shiny cover. $10,000 Gold came out 3 years ago. Other people are bringing up the same number for gold, $10,000 Gold, namely Jim Rickards, who's a best-selling author. Let's just go ahead to Nick. Nick, thank you for joining us today from Canada.
Hey, my pleasure again.
Nick, I wanted to talk with you in the pre-interview. I talked about your clients, and I talked about how you're vaulting a $350 million worth of gold, silver, and platinum for clients around the world. And what do your clients make of these dreadful warnings from people like Bill Gross talking about how the markets could go supernova, and Carl Icahn on the phone with CNBC saying the thing can blow up, quote, blow up. What are you hearing from your sources, your clients around the world?
Well, we deal with primarily financial advisors and some high net worth clients and family offices and so on. It's still not a big movement. It's like we've had a 4-year correction. So it's one thing when the Bill Grosses and the billionaires are kind of getting the vulnerabilities, but the retail public, the retail advisors, they're still not there. And this is not unusual. Like after a correction of this depth, and there's been an enormous amount of negative publicity over the past 4 years, that people are being turned off of precious metals and have been investing in traditional financial assets that have been growing into ever increasing bubbles. The same kind of thing happened in the 70s. Like gold went from $35 to $200 by 1974, then dropped 50% to 100, and then from 76 to 1980 went to 850. Well, so many people had thrown in the towel, on the 50% decline, that the public didn't get back into the market till about 1979, just as you were about to peak, over the top. So these are the kind of delays you get from the broad markets after a major correction. And I think the public at large still not there. The very sophisticated investors are clearly getting worried, and there's numerous articles on the subject, but the public at large isn't there yet.
But you are seeing that your clients that are starting to smell fear. Your big clients that vault gold and silver, your big institutional clients and high net worth people, are they starting to smell fear?
Yeah, there's plenty to be concerned about, and the issue is like a lot of attention is on Brexit and what will happen to the gold price if things go one way or the other. But no matter which way the Brexit goes, after the vote is done, all the vulnerabilities and the problems still exist, and it's hard to believe it. When I wrote the book 3 years ago, I talked about the issues that would lead to $10,000 gold. Well, those issues are still there and have gotten much worse. So none of the issues have been solved. We're now into multiple bubbles. A lot of them, surrounding debt. Debt keeps growing all over the world, and that's the main correlation to the price of gold.
It seems what they're doing over in Europe, buying corporate bonds, is just about the time you think, oh my gosh, they're not going to be able to do anything else. They just start buying corporate bonds to continue to hold interest rates down because their corporate bonds are paying more. What do you think about the possibility this time? It won't be 1980. It'll be something like Mad Max. I mean, the system sounds to me like it's in deep trouble.
Well, that's the thing. When you go back to 1980, we had a rise in interest rates, over the late 70s from, maybe 7 to 8% into 18%. The average interest rates have been about 5%, but we couldn't get anywhere close to back to 5%, and for it to be sustainable on any level anywhere.
Do you so you're saying that the low interest rates is going to be, they're not going to be able to jack them up like they did, from 5 all the way up to 1980, when Paul Volcker came in and said, we're going to have 20% interest rates for money. We don't want people buying the gold. You're saying that's not going to happen this time. It can. It would just raising interest rates, 1%. People think the whole system could come down. Is that what you're saying?
Exactly. Like we can't get into anything close to normalized interest rates. And I think, Mohammed Al-Arian was on CNBC a little while ago. He says that he doesn't think interest rates are ever going to go up.
Well, then something's going to have to go up. I mean, if you don't have the real time value of money, who is going to buy bonds? If they can't get an interest rate of return, who is going to buy bonds? Who is going to save money?
You've got considerable amount of sovereign bonds that are at negative interest rates. So what can we do? That can go more negative than this already. This is one of the long-term driving factors, because there isn't the argument that gold doesn't have a yield and therefore isn't worthwhile as an investment. Well, many bonds don't have a yield either. And the corporate bonds that do have yields are extremely high risk, and I think have got nowhere to go but down.
Well, I mean, we have 10 trillion, supposed 10.4 trillion in negative interest rate paying sovereign debt. I mean, that is, one report said it was 8 times bigger than subprime. I mean, what's the logical conclusion here? We don't all just glide in for a safe landing, do we? I mean, aren't these big players talking about explosions and supernovas? I mean, doesn't this at some point just blow up and everybody runs through the exits?
Well, I think so. This is where you've got to have massive defaults, and this is one of the things that people are thinking we're going to have a gold market that's a steady stair step up. I think this isn't the way it's going to happen. At one point in time, we're going to have like a dramatic increase in the price of gold, and it'll become extremely difficult to obtain gold in any quantity at that point in time. So people that think that when it's obvious that we have a crisis on our hands, and then they can go and buy gold, that's not going to happen.
What are big clients doing? You wrote an article about how they're making the mistake of buying GLD and SLV, and there's been a lot written that these mechanisms don't have the gold and silver that they say they have, and you'll play heck trying to get real return, real value out of these funds. What say you about these exchange traded funds?
Well, the issue is that they do have bullion in them, but the missing part that everybody thinks they operate similar to an open-end mutual fund where the trustee goes in and buys bullion. That's the way our open-end funds operate. But in the case of ETFs, regardless of whether they're equity ETFs or gold ETFs, you have authorized participants contribute baskets of a predetermined nature, and they get newly issued shares of the ETF, which they sell to the customers. The issue is that the assets that go into the ETF, while you can say, well, the ETF has these assets, they're borrowed assets. That's the whole problem of the risk. And in gold, the issue is that when a central bank leases gold, the title to the gold remains with the central bank. That's why it's called leasing. Just like in a car lease, title isn't transferred. So the central bank gold is sitting in an ETF, and if an authorized participant was ever to go bankrupt, the central bank's going to call back its gold. and all the ETF investors are going to end up taking gigantic losses. And people just don't understand that. They also don't understand the mechanism and the connection between the naked shorting on the COMEX, which is being done by the same authorized participants that are then redeeming ETF shares for physical bullion out of the ETF. So it's a two-staged aspect of it. Now, anybody that pays attention, it should be clear that the gold markets, as well as some of the other markets, are not normal markets. Several of the banks have admitted to manipulating the different markets. And there's numerous lawsuits going on now about manipulating the gold market. So I think anybody that takes the time to look into it will realize that these are not normal markets. But the thing is that with the ETFs, we've had a huge diverting of investment demand into ETFs, and that investment demand has no effect on the fundamentals of supply and demand for gold, because it's borrowed gold.
Well,
if the money was going into physical bullion instead of the ETF, the price would be multiples of what it is today.
What you're describing is a giant fraud, and I want to circle back to the bank. You talked about a market correction. Listen, there was a market correction in the mid 70s, where the price got cut in half. You didn't have Deutsche Bank admitting with other, which is a primary dealer in treasuries. I mean, this is off the charts. This isn't a correction. This is a fraudulent takedown that took 4 years that Deutsche Bank got caught and named Bank of Nova Scotia and also named HSBC, among some other banks. But this is a huge fraud, not a correction, right? I mean, the debt exploded, the advice was sound, but the fraud made the advice not look sound. Am I wrong?
No, you're absolutely right. This has been happening in all markets, and when you have a manipulated market at some point in time, you have a massive correction back to what would be the norm, and then usually it overshoots the norm. It's like keeping a balloon underwater that sooner or later it's going to pop, and that's what we've got now.
Your massive correction, you're predicting a massive correction to the upside?
That's right, to catch up where it should be. Like in my book, one of the main conclusions to get to $10,000 gold was there was almost a perfect correlation between the gold price and the amount of U.S. debt up until 2012. So since then, the U.S. debt has continued to increase, and the gold price corrected. Right now, if we were to get back to that correlation, the gold price should be around 2,300, and there is no end in sight of the increases in debt, like in any Western country. So this is just going to keep rising and rising, and as you increase debt, you're actually increasing the money supply to create the debt.
Yeah. What about silver? What should be the price for silver? A lot of people, when I have people, I know you wrote a book called $10,000 Gold, but you vault silver, you vault platinum. What would you say? Where should silver? I mean, it's what, 1750 around, plus or minus. And you're saying, what should silver be right now? $50?
Well, that's a good number, because right now we've got a totally disproportionate gold to silver ratio. And so getting anywhere close to the norm gets you up to numbers like $50. And
that seems low to me. Hold on, that seems low to me. Well, I guess maybe not. I mean, if gold is $1,900 an ounce back in 11, and silver was $50, I guess at 2,300 to be a skosh higher, right? Maybe $60 an ounce. Is that what you're something like that? Some metric like that?
That's right. And the same thing applies for platinum, because platinum is for the first time that I've seen that you have platinum below the price of gold. So, you've got a situation where platinum's got to get back to norm, which is several $100 above the gold price.
So name off what should gold, silver, and platinum roughly be right now if they wouldn't have fraudulently manipulated the markets?
Well, I think it's the 2,300 gold, and 2,600 platinum, and 50 to 60 silver.
And you think that silver is that a good investment? Jim Sinclair has said that silver will be like gold on steroids when this thing finally blows open. What say you about the price of silver when this comes to its ultimate end?
Well, I agree with it, and the interesting thing there is that silver is effectively the price is inelastic in terms of both supply and demand. 80% of the supply comes with byproducts, so if the price of silver was to go to 50, 60 bucks, you're not going to increase mine production because it's only 20% as a byproduct. So you're going to have no effect on supply. There's relatively few pure silver mines. On the demand side, it doesn't make any difference like in the industrial use of silver. If the price of silver is current price of 60 bucks, because the amount of silver in your iPhone is less than 50 cents. So it's going to have no bearing on the price of the iPhone or anything else electronic. And in those electronic components, there is no alternative to silver, from a conductivity point of view, than gold. And that's a long way to switch from silver to gold.
So if you're saying if silver quadruples, it's 60 bucks roughly, or that'd be, instead of 50 cents in your iPhone, it'd be $2.
That's right. So it'll have no effect on it. Same thing, if platinum, which is used for catalytic converters in diesel cars and trucks, in the trucks you're using maybe a half ounce of platinum in the catalytic converter on a truck that might be $100,000 truck. So again, it's not going to make any difference in terms of the end price of the product. But without the silver, without the platinum, you don't make any of the products. You don't build diesel cars or trucks, and you don't make electronics without silver.
And you're saying we're heading for a giant short squeeze where the price vaults higher at some point for all these metals at one time. Am I hearing that correctly? Could you explain that to me?
Well, that's right, because it'll be some event. So for example, apart from the ongoing issue of increasing debt all over the world, you've got a couple of major vulnerabilities. One is that the U.S.-Saudi relationship politically is deteriorating. And at some point in time, it's a good chance that the Saudis will announce that they will sell oil in yuan, euros, British pounds, whatever, and not limit it to U.S. dollars. So that's going to change the entire reserve currency status of the U.S. dollar. The second thing is China is being accepted as a participant in the IMF's SDR, and the actual implementation is scheduled by the fall. Now, at this point in time, China's official gold holdings are 1,600 tons, but many analysts have looked at it and consider that there's 4,000 to 6,000 tons in total. But that difference is being held in the China's sovereign wealth fund, not in the central bank. So once the implementation gets going, it's in China's interest to announce their true gold holdings, and right now they're only getting a 10% allocation of the SDR, and based on GDP and other issues, they need to be well above 20%, and the only way they can do that is announce that they have 4,000, 5,000, 6,000 tons, which is their stated objective. They've stated it several times.
Some people say they have much higher, 10,000, 12,000, 15,000.
It could be.
So you're saying that they got at least 6,000 tons. They have almost what the U.S. claims it has.
Right. Now, where the problem comes in, from Western central banks, if China does in fact, let's call it for ease of arithmetic, 5,000 tons. The question is, where did the 5,000 tons come from? Because the supply-demand statistics have everything accounted for. So they don't show this mechanism of China buying. So the issue can only come out of leased gold from the Western central banks. And as soon as China announces that they got 5,000 tons, that means the Western central banks have 5,000 tons less than what they purport to have.
Oh, you're saying that the Western banks may end up saying, as you set up, they may say, yeah, no, we're going to keep the gold. No, we need the gold. Gold goes up to 10,000 an ounce. They're going to default on these leases, are they not? They're going to say, no, we own this gold. Sorry, it's $10,000 an ounce. Is that what you're telling me?
No, I'm saying that the gold is already being shipped to China.
Oh, it's not leased if it's shipped to China.
Into 1 kilo. The gold starts off as London good delivery bars, is shipped to Switzerland, is made into Chinese kilo bars, and shipped to China. So it's not coming back.
So this is the leased gold is not leased gold. The leased gold is now China's gold. That's what you're telling me.
That's right.
Well, that's going to be devastating for somebody's stated gold holdings. I mean, if somebody's out there saying they got 3 tons or 8 tons or whatever, and they really don't have that, that's going to crush them, is it not?
This is the anomaly, because when a central bank leases its gold, let's say to a bullion bank, and the bullion bank, sells it or deposits it, with an ETF, title to the gold technically stays with the central bank. So they're allowed to show that they still own gold. If you look at the central bank balance sheets, it doesn't say we had so many tons in bullion and so many IOUs from this bullion bank for the leased gold. They only have one line item saying they have the gold.
Oh my gosh, you're saying that a lot of this gold could just be paper contracts and leases that they don't have the gold. It's gone. It's in kilo bars. It's in China. That's what you're saying.
That's right.
Oh my gosh.
Because there's no other rational explanation how China could have the 4,000 to 5,000 tons, and there's a lot of good evidence that they have that amount. But where does it come from? Because if you read the supply-demand statistics, that's being accounted for.
Is the math with this, is it just going to blow up? Are we just going to have a tremendous repricing and crash at some point?
Well, there's a book, The Big Reset. Jim Rickards talks about a reset, and that's why I'm saying that in a reset you get an instant repricing. You don't have this gold price rising $25 an ounce or $50 an ounce and steadily increasing. Everybody gets the opportunity to buy in. One morning you're going to wake up and the price of gold is several $1,000s higher.
Very interesting. Very, very interesting. Your prediction. Your book, I'm holding it up here, $10,000 gold. It's very predictive. I mean, wrote this 3 years ago. You could have wrote it 3 weeks ago. Nick, thank you for coming on USAWatchdog.com. I appreciate you coming on and taking us to school in the gold market. Nick Barisheff, the Bullion Management Group, BMG. Nick Barisheff, the CEO, thank you so much for coming on. Oh, incidentally, you can find his book, $10,000 Gold, on the homepage. I'm going to link to the BMG.com website. Nick, thank you so much for joining us today on USAWatchdog.com.
My pleasure as always, Greg, anytime.